Let's start with introduction. The Central Bank of Malaysia, or known as Bank Negara Malaysia, is a statutory organisation that began operations on January 26, 1959. Its primary goal is to promote financial and monetary stability to help grow the national economy. Under the Central Bank of Malaysia Act 2009, Bank Negara Malaysia is entrusted with the responsibility of fostering an environment that supports long-term economic growth in the country. Its main role is to ensure the promotion of monetary and financial stability. This is crucial because financial stability lays the foundation for sustainable economic growth. Bank Negara Malaysia's regulatory framework is important to the stability of the financial system, which include overseeing various sectors such as banking, insurance, and payment system. Thus, this includes the supervision of both conventional and Islamic banking sectors, risk management, capital adequacy, and consumer protection. The framework is designed to ensure that financial institutions operate with high standards, providing stability in the market and safeguarding consumers' interests. Our main is to examine the regulatory framework established by the Bank Negara Malaysia, which highlighted the challenges and opportunities that arise from these regulatory distinctions. To understanding these differences between both practitioners and scholars to appreciate the complexities of Islamic banking and its integration within the broader financial landscape of Malaysia.
We move forward to 3.0 Regulatory Framework for Islamic Banking. So, Sharia compliant product and the regulatory support provided by Bank Negara Malaysia. As a central bank, BNM plays a crucial role in establishing a regulatory framework that aligns Islamic banking practices with Sharia principles. The first one, Sharia Compliance and the Islamic Financial Services Act, IFSA 2013. IFSA 2013 are introduced by BNM, which provides a robust regulatory and supervisory framework, aligning financial practices with Sharia requirements. This includes prohibits riba and gharar, while ensuring investment and transaction adhere to Islamic principles and avoid non-compliant sectors. BNM require each Islamic bank to establish a Sharia committee to monitor and ensure compliance with Islamic law in all banking products and services. BNM also established Sharia Advisory Council, which is SAC, resolves Sharia compliance issues by standardized interpretation of Islamic financial principles and provide guidelines to Islamic financial institutions. According to Go and Ramli 2019, the SSC rules and IFSA 2013 frameworks position Malaysia as a global hub for Islamic finance with internationally recognized Sharia compliance standards. Second, Sharia Governance Framework 2019. The Sharia Governance Framework was established by Bank Negara Malaysia to enhance Sharia compliance and governance in Islamic financial institutions and to aim at strengthening the Sharia compliance process by delineating the responsibilities and roles of various stakeholders within an institution. This includes financial products, management procedures, and daily operation. For example, the Board of Directors is responsible for providing oversight, as for the Sharia Committee acts as the main advisory body, offering expert guidance on Sharia matters. The management team is tasked with implementing Sharia decisions in daily operations, while the internal audit function monitors ongoing adherence and identifies potential compliance gaps. Together, the Sharia governance framework reflects Malaysian commitment to global leadership in Islamic finance by creating a regulatory environment that aligns Islamic financial institutions with the ethical value and principles of Sharia law. Third one, product structuring and risk sharing. In Islamic banking, financial transactions are structured around profit sharing, leasing, and lease agreement rather than conventional interest-based lending. Products such as murabaha, mudharabah, and ijara ensure compliance with Islamic principles by prohibiting riba and gharar. Also, risk sharing is a key element in Islamic banking, aligning with Islamic values of equity and ethics. For example, in mudharabah, a profit-sharing model where the bank provides capital while the client contributes effort and expertise. The profit are shared based on the predetermined ratio, while the financial loss is typically borne by the bank as the capital provider, except in case of misconduct by the client. Profits are distributed according to the set of ratio, but the bank which provide the capital usually bears the financial loss unless the client is incompetent in wrongdoing. Number 4. Sharia audits and compliance. These audits are designed to evaluate whether Islamic financial institutions are adhering to Sharia principles in every aspect of their operations, products, and contracts. The audit process includes reviewing product structures, financial contracts, marketing practices, and operational procedures to detect any areas of potential non-compliance. Sharia audits are conducted by both internal Sharia auditors and external Sharia audit firms, each providing an independent and unbiased review of the bank practices. As international Sharia auditors are responsible for ensuring compliance on an ongoing basis. For external Sharia auditors, they are conducting periodic reviews to verify that the bank activities align with Islamic principles. Next, capital adequacy and liquidity management. BNM approach to capital adequacy for Islamic banks reflects the distinct nature of Sharia-compliant financial activities, emphasize the need for robust capital buffers to absorb losses while adhering to Sharia principles. By adapting Basel III standards, BNM ensures that Islamic banks maintain sufficient Tier 1 and Tier 2 capital tailored to address risks unique to contracts like musyarakah and murabaha. As for liquidity management, in Islamic banks present unique challenges due to the prohibition of riba and gharar. To address this, BNM has introduced instruments like sukuk that offer a tradable asset-backed alternative to conventional bonds, while commodity murabaha facilitates liquidity through real economic transactions involving the sale and purchase of commodities. Furthermore, platforms like Bursa Malaysia Suq Al-Sila provide structured environments for this transaction, ensuring compliance and market efficiency. These innovations have strengthened the ability of Islamic banks to navigate risk and maintain resilience within the broader financial system. Last but not least, dispute resolution mechanism. Islamic finance dispute often arise from the unique contractual arrangement and interpretation of Sharia law, which differ from conventional legal system. BNM mandates that dispute involving Sharia issues be referred to the Sharia Advisory Council, which is empowered to provide authoritative guidance on Islamic legal principles. The SSC serves as the highest authority for interpreting Sharia matters in Malaysia's Islamic financial system. Its involvement is crucial in resolving dispute over contract structures, profit sharing ratios, or issue of compliance with Islamic principles such as riba or gharar.
Assalamualaikum. My name is Nur Azira binti Zaid. My metric number 298512. I will present about the regulatory framework for conventional banking. The Financial Services Act 2013 governs conventional banking, setting essential rules that shape operation, business structures, and liquidity. These regulations are crucial for providing competitive services, protecting investors, and safeguarding customer interests. We go to the first framework, which is Banking and Financial Institution Act 1989. BAFIA was a pivotal Malaysian law for licensing, regulating, and supervising conventional banks. It established guidelines for capital adequacy, governance, and risk management, empowering Bank Negara Malaysia to ensure compliance and stability. In 2013, the Financial Services Act replaced BAFIA to address modern financial challenges. The FSA consolidated financial laws, strengthened financial stability through global standards like Basel III, and integrate frameworks for conventional and Islamic banking, reflecting Malaysia's dual banking system. BAFIA laid the regulatory foundation for Malaysian banking sector, while the FSA demonstrates adaptability and competitiveness in a globalized financial landscape. Next, Financial Services Act 2013. FSA modernized Malaysia's financial regulatory frameworks by replacing older laws like BAFIA and unifying regulation for banking, insurance, and other financial services. It emphasized financial stability, regulatory transparency, and robust prudential standards, while strengthening oversight, crisis management, and consolidating disparate laws. Applicable to conventional financial providers such as banks, insurance, and payment systems, the FSA also regulates takaful operators, electronic payments, and coordinates with the Capital Market and Services Act 2007 to ensure market integrity and fair practices. By prioritizing systemic risk management, consumer protection, and alignment with international standards, Bank Negara Malaysia enhanced Malaysia's competitiveness as a financial hub. Next, we go through interest-based lending and deposit accounts. Bank Negara Malaysia framework for conventional banks ensure fairness, transparency, and alignment with Malaysia financial stability goals. It regulates interest-based lending and deposit accounts, overseeing interest rates on loans, credit cards, overdraft, and deposit. BNM prevents predatory or excessive rates, protecting borrowers and depositors. Banks must disclose interest rate, fees, and terms to ensure customers understand the costs and benefits of financial products, promoting informed decision-making. Furthermore, short-term and long-term financial products. BNM oversees short-term and long-term financial products by setting guidelines for customer protection, repayment terms, and credit assessment to prevent excessive debt and ensure fair lending. Short-term products include loans, credit cards, and overdrafts, while long-term products like bonds and treasury bills fall under BNM framework. Conventional banks use fixed-rate financial instruments for stability. BNM also emphasizes financial literacy to help consumers understand products' implications. Next is profit maximization and risk management. BNM enforces governance standards to ensure that banks responsibly maximize profits while effectively managing risk. Banks are required to establish robust risk management frameworks to maintain financial stability and avoid excessive risk-taking. Regulations are in place to protect customers from unfair practices, ensuring that profit-driven operations do not exploit depositors or borrowers. Additionally, BNM encourages banks to adopt environmental, social, and governance practices, aligning profit goals with responsible lending and investment strategies. By supporting ESG initiatives, BNM not only emphasizes financial stability but also promotes investment that benefits society and the environment. Next, capital adequacy. BNM Capital Adequacy Framework ensures banks maintain sufficient capital to cover potential losses and safeguard the financial system stability. Based on Basel III, this framework improves risk management by requiring banks to hold capital proportional to their risk-weighted assets. However, according to Harzi 2012, studies suggest that Basel III focus solely on conventional banking without addressing Islamic banking. For conventional banks, BNM capital adequacy standards aim to maintain consumer confidence, prevent excessive lending, and promote flexibility in the financial system. Then we go to the liquidity management. BNM Liquidity Management Framework ensures financial stability by requiring banks to hold high-quality liquid assets to meet short-term obligations and manage liquidity risk. The liquidity coverage ratio is a key measure ensuring banks have immediate access to funds during economic stress or unexpected demands. To reduce reliance on short-term borrowing, BNM emphasizes funding diversification, regular liquidity assessment, and strong internal risk monitoring. Stress testing helps banks identify the weaknesses and take proactive measures to address potential risks. And last but not least is consumer protection. Bank Negara Malaysia Consumer Protection Regulation ensure fair treatment, clear disclosure, and accessible dispute resolution for customers of conventional banks. This measure promote ethical banking, protect consumer rights, and boost public confidence. Banks must cater to customer financial needs responsibly, prevent over-indebtedness, and recommend suitable products. Transparency is enhanced through strict disclosure standards, requiring accurate and complete information on financial products. Dispute resolution mechanisms such as the Financial Ombudsman Scheme ensure prompt and fair complaint handling, supported by internal procedures and the Financial Services Act 2013.
I will be presenting on differences in the regulatory framework of BNM for Islamic and conventional banking. So, let's move to the first point, which is governance and Sharia compliance. In Islamic banking, the Sharia board is essential to ensure all transactions and products comply with Islamic law. Their responsibilities include issuing fatwa, conducting audit, calculating zakat, and ensuring all operations adhere to Sharia principles. They are supported by the Sharia Supervisory Board, which consists of scholars well versed in Islamic jurisprudence, particularly fiqh al-muamalat. In Malaysia, Islamic banking operates under three governance structures, which are standalone Islamic bank, Islamic windows within conventional banks and Islamic subsidiary of conventional banks. This structure ensures a robust framework that promotes ethical and compliant practice. While in conventional banking, there is no equivalent to the Sharia board. Instead, governance is overseen by committees such as the Board of Directors and Audit Committees, which ensure compliance with financial regulation. Their primary focus is on profitability and following secular laws, contrasting with Islamic banking, emphasize on fairness and Sharia compliance. This allows conventional banks to operate more flexibly but with less focus on customer welfare. Now, moving on to the second point, which focuses on the enforcement of core principles. In Islamic banking, equity and risk sharing are central principles. This ensures profits and loss are shared fairly between banks and customers. For instance, Mudarabah focuses on profit sharing, while Musyarakah emphasizes joint venture with shared risk. The Sharia Supervisory Board ensures these principles are upheld and that all operations comply with Sharia law. This includes prohibiting riba, gharar, and maisir. Through clear guidelines from BNM, Islamic banking maintains ethical practice, promoting transparency and long-term financial sustainability. In contrast, conventional banking operates on interest-based lending, known as riba, where banks earn fixed return while the borrower bears all the risks. This system prioritizes profit maximization, making operations simple and more efficient. However, it lacks fairness and shared responsibility as seen in Islamic banking. The focus here is purely financial gain without the ethical consideration emphasized in Sharia compliance. Moving on to the third point, which highlights innovation and product development. In Islamic banking, product innovation focus on Sharia compliance. Some key products include asset-based financing like Murabaha and Ijarah, which use asset as collateral to reduce risk. Sukuk or Islamic bonds that promote risk sharing and financial stability. Takaful, which is Islamic insurance based on mutual cooperation and shared responsibility. And Islamic saving accounts such as Mudarabah that ensure profits and risk sharing between banks and customers. This innovation not only meet customer needs but also strengthen customer confidence and help Islamic bank remain competitive globally. This is supported by clear guidelines from BNM. In contrast, conventional banking operates on interest-based lending, known as riba, where banks earn fixed return while the borrower bears all the risks. This system prioritizes profit maximization, making operations simple and more efficient. However, it lacks fairness and shared responsibility as seen in Islamic banking. The focus here is purely financial gain without the ethical consideration emphasized in Sharia compliance.
To conclude overall, we can see that the regulatory frameworks governing both Islamic and conventional banking in Malaysia play an essential role in maintaining a stable, transparent and effective banking system. Therefore, Islamic Financial Service Act, or we call as IFSA 2013 by Bank Negara Malaysia has been instrumental in ensuring that the sector aligns with Sharia principles. This act not only sets essential standards for governance and financial stability, but also explicitly addresses Sharia compliance across all banking activities. Also, key challenges Islamic banks face is managing capital adequacy and liquidity, given the prohibitions on riba interest and speculative transactions gharar. Conventional banking in Malaysia is supported by a strong regulatory framework, including the Banking and Financial Institution Act Rafia 1989 and the Financial Services Act 2013. These regulations ensure that the stability and efficiency of the banking system, covering a wide range of banking operations from interest-based lending to long-term financial products.